Hello, trader friends. Today, I'm going to show you something really cool, something incredible, an alternative to buying long stock. If you want to buy stock or you buy stock regularly, you want to watch this video because this strategy, it's an alternative. It's another way of buying stock and getting longs underlying that you want, like Apple, SPY, anything. And let's compare both scenarios, the wheel strategy against buying long stock, and see which one fits your risk profile, fits your capital requirements, and fits your style of trading. So let's get to it. This is the chart that I will be using today to compare both the wheel strategy and getting long stock. So now let's go to our beautiful and incredible Tasty Trade platform and see and get started doing our little comparison. Alrighty then. So I know what you guys keep telling me, that you don't want to see my beautiful face, so I took it off the screen. And also, I bought a new microphone. Please let me know in the comments below if you like the new microphone. I bought a super expensive microphone because I want you guys to have a good experience watching the videos. So now let's get to it. I like to start with SPY, and let's look at both scenarios. SPY is trading right now at $501.16. So this is the scenario that it's going to be very easy right now because, $500 is a round number. And let's compare the two scenarios of buying 100 shares of stock at $501. If we click review and send, here we can see that we are going to be spending $50,110 to buy this individual stock. $100 multiplied by $501 equals to $50,110. Now, if we want to see how much margin it takes up on a margin account, let's go and take a look at the screen. I'm going to go full screen here so everybody's happy. And then I'm going to put 100 shares here on the Tasty Trade platform, go review and send. And we can see that in a regular margin account. Now, what happens if we want to sell one at the money put? And in our SPY, the Tasty Live ways, we go 45 days. I have March 28 is 46 days. The at the money is the 501 strike. I click on it, and here you have it. Buying power effect of $10,000. So that is interesting. Let's take a look at our Tasty Trade platform. And if you see on the bottom right of the page, we can see that we have a maximum profit of $721. It has 64% probability of profit, and it has a buying power of $10,006. That $10,006 is much less than the capital requirement of $25,000. So here it is. Here's our first comparison. Capital requirement to sell one short at the money put, 45 days, $10,000. Capital requirement on a regular margin account to buy 100 shares, $25,000. Now, let's take a look at the deltas. Now we're back on our beautiful Tasty Trade platform, and let's take a look at the deltas. First, let's go and click on the bid and the ask. If you click on the ask, you're buying 100 shares. If you click on the bid, you're buying 500 shares. Let's click 100 shares at $501. And we can see that 100 shares have 100 deltas, have 100 long deltas of directional risk. See, one share equals one delta. Now, what happens if we go to the 46 days, March 28, we click on the at the money put, and normally we already know this, boys and girls, the at the money puts and calls normally are 50 delta. So if we sell one at the money put, we're coming on around 50 long deltas of being long the product. Now, let's keep building our comparison, and now let's start to look at our break-evens, for our strategy. So with buying stock, the break-even is quite easy because the break-even is the strike price that we paid for the stock. Now, on the wheel strategy, that is not the case. our break-even price will be exactly the at-the-money strike price minus the credit received. Why? Because we're putting money in our pockets, and that money gives us a little cushion that just in case we're wrong, we don't lose money for that credit received. And let's make that comparison. If we go back to our beautiful Tasty Trade platform and we go to the analysis page, you just have to go and click curve and analysis. You can see here that when we're long 100 shares of SPY, for every dollar that SPY goes up, we make $100. And for every dollar that SPY goes down, we lose $100. So it's quite easy to understand. Everybody understands if you buy stocks at $501, it goes down to 500, we lose $100. If it goes to $502, we make $100. So this is the beautiful risk chart of being long stock. Now, let's clear this out. Let's go and sell our 46-day. We open the 46-day expiration chain, and then we click on selling the naked put, and then we go to the curve analysis. And here, let me increase it a little bit more. So here we can see that actually something weird happened. Number one, to the right-hand side, meaning to the upside, the only profit we can make when we sell a short put is that $7.21. So that means even if SPY goes to the moon, we can only make $721. On the other side, if SPY goes down, look, if SPY goes down here to $497, we're still going to profit $329. If SPY goes to $395, we're still going to make $117. And our break even is going to be here, located around 400 at the price of 493. Why? Because the SPY is $501. We're taking in $7 of credit. So that's how we get to our break evens. And now that we see the comparison, and you start to see the differences between being long stock and selling an at-the-money put, let's put it down on our beautiful comparison page. So here we are. Once again, if you buy long stock, your break even is the price paid, $501.16. If we go up, you make money. If we go down, you lose money. Now, the break even of the 501 strike put gives us a credit of $7.21. So our break even, to be exact, using my trusty calculator, my $5 calculator, it's $493.79. So SPY can go down $7 and we're still not losing money. And if it goes down less than $7, we're going to be able to collect a nice little profit for ourselves instead of taking risk. So why? So here's the number one thing that you need to know. If you want to buy a stock, but you're unsure about your entry, you're not sure if this is the right time to buy, instead of buying 100 shares of stock, immediately I can see that if I sell the at-the-money put, we're going to be much, much better off. Why? Because we have a little cushion of $7 that will allow us not to lose money until we hit $493. I want to touch on two very important key things we need to understand. So if you want to be a successful trader, you have to understand this concept of cost basis reduction. What does it mean? You buy something for $1 and you start selling stuff so your cost goes down. Let's say you buy a house for $1 million and you rent your house out for $100,000 the first year. Well, now you have a cost basis reduction of $900,000. Forget about taxes, forget about property tax and maintenance. Just bear with me. You buy a house for $1 million, you get a rent for $100,000. Now you reduce your cost basis to $900,000. Same thing we can do in stock. If we buy shares at $100 and we sell a call against it for $5, now our cost basis is reduced to $95. If we sell an at-the-money put, then if we get assigned the stock, let's say we sell an at-the-money put for $5, then we would have a cost basis of $95. And now let's take a look at our comparison to see what the effect of selling one at the money put has on our cost basis on our SPY example. So here we are. So SPY is trading at $501.16. If SPY goes down $20, which is a big amount, you know, it is a big amount. It is a big amount. It's a few percentage points. Then the SPY would go down to $481.16. And that so if we go down 20 points, our new cost basis is going to be $481. If we have 100 shares, we would lose $100 per every point. So if we lost 20 points, that would give us a loss of $2,000. Now, what happens if we sell a naked put? If we sell a naked put, we saw that our cost basis, you see, selling a naked put, you're already learning how to reduce cost basis. Selling a naked put reduced our cost basis to $493.79. And if SPY goes down $20, $20 Rucos, then we only lose $1,263. Why? Because if SPY goes down to 481, here we have it. And let me grab my little thingy here. If SPY goes down to $481 and our cost basis is $493, not $501, you see, we only lose from $493 to $481. We lose $12.63. Multiplied that by 100 shares of stock, and we only lose $1,263. So if you are not very sure of your trades, if you're not sure of your entry for buying a long stock, maybe this is selling one at the money put. I think gives you a bigger cushion if we go down and if you didn't time the entry correctly. So far so good for the at the money put. It has less capital required. It has cost basis reduction. We lose less money if we go down. So far, I think I'm liking the at the money put compared to buying long stock. This video is called the wheel strategy, right, Tony? Not the selling one at the money put video. Although, you know, if you watched till this part of the video, you can see a clear comparison of selling one at the money put compared to just buying 100 shares of stock. Now, a wheel is a circle of trust, the circle of trust. Why is it called a wheel? Because then everything comes back to its origin. And how does it come back to its origin? So let's take a look at our beautiful, tasty trade platform. So what happens if we go down below our strike price? So if you do not roll the put, and if you want to understand how to roll puts, please watch my video on how to roll puts down and out. I think that's one of the key trading skills and that a good trader can have. But if the SPY trades below $501, you will get assigned and 100 shares of stock. What does this mean? That means that after expiration, after those 46 days, you're going to wake up in your account, you're going to have 100 shares of stock. Now, we must keep the break even, which is around $193 and some cents. So let's round it up to $194. So we have to pretend now that our cost basis is $194. Why is that important? So let's say we got assigned our 100 shares of stock at $194. That means here we are. We're here at the 494 strike price. That's our new cost. But what if you're afraid that SPY will keep going down? Tony, I'm afraid SPY will keep going down. So this is the second part of the wheel strategy. So we know our break even is let's say 494. And what can you do when you own 100 shares of stock? So when you own 100 shares of stock, what you can do is sell a call against it. So here we go. We sell a call. We sell a call against it, and we're going to collect. I'm going to round things up because I'm lazy today. So instead of $13.97, let's pretend we're going to collect $14 for our naked call. I mean, and sorry, it is not naked. It is not naked because we have 100 shares of stock and we sell one call against our 100 shares of stock, and that covers it. It's a covered call. And we're turning a naked put. We got a sign on the naked put and we turn it into a covered call. Now let's do some math. Let's see what our new break evens are. Let's take a look at our beautiful comparison chart. So, what is our break even in SPY on the right hand side for a regular 100 shares of stock? Where 100 shares of stock, we still paid $501.16 for them, right? So, actually, our cost basis is still the same, $501.16. Now, if we go to our beautiful left-hand side where we sold a put, got assigned, and then we sold an at-the-money call at our new cost basis for $14, we can see here very clearly that our cost basis was around $494. We sold a call at the money call for $14. Our new cost basis is $479.79. And what is really, really incredible is we have a $21 cost basis reduction versus our stock. And I know what you guys are saying. Hey, Tony, I really did not get where did that $21.37 came from. Well, it came from this. So remember, we first sold an at the money put for $7.21. Remember, at the money is where the most juice is located. So we sold a at the money put for $7.21. Then we sold a at the money call for, you see that I did a turbo circle and the computer didn't want to make it round for me. Let me see. Let me try this again. Nope. Last try. If I cannot make a beautiful circle and the computer, so forget it. The computer didn't like it. So $7.21 plus the $14 that we sold for the call, it gives us around $21 cost basis reduction. And now our new cost basis for our stock is $479.79. So to round it out, we are at $480 compared to $501. So that's $21 below. $21 divided by 501, we're actually 4% down. That means if you do a wheel strategy, you are already have a cushion of 4% down. 4% is quite a significant down move. 21 points, that means you have a significant cost basis comparison to whatever the SPY is doing. And imagine, so let's say SPY goes down 40 points. And if you had 100 shares of stock and SPY goes down 40 points, you'd lose $4,000. If on the left hand side, SPY goes down 40 points, which is almost 9%, and then you would only lose $2,000. So you would lose half of it. Why? Because your cost is 480 instead of 501. Okay, now that we have our wheel strategy on, what are the scenarios that could happen? So there's, a stocks can go and do let's say 5 things. One, they can stay the same. That means the stock doesn't move. It can go up a little. Number 2, it can go up a lot. Number 3, it can go down a little, or it could go down a lot. So let's try to see what happens if some of those scenarios play out with our stock. And for this, I want to go back to our beautiful Tasty Trade platform and see what happens. So if we have our wheel strategy, right? We already sold our put, sold our call, and our break even right now is around $480. And at $480, if you have stock and it goes up $1, you're going to recuperate $100 of your loss. If SPY is above your break even price of $480, you will make money. you will absolutely make money. And let me show our screen over here again why that is the case. Because your break even is $480. We sold the $494. So if SPY is above or between, let's say, 480 and $494, you will make 100% of those $14 that you collected, minus the difference between the 494 strike price and where the SPY is trading. What do I mean? Let's pretend SPY went down another 4 points to $490, right? So we put in our pockets $14. The SPY went down $4, so that means we made we were able to keep $10 of our stock. So that's the scenario where SPY goes down a little. If SPY goes down a lot, let's say SPY goes down to 480, then we keep the $14 that we sold for our call, and then we're break even. Now, if it goes down to 470, which is down a lot, we also keep the $14 that we have on the trade, and then we would be losing, only $10 because our break even was 480. So, but if SPY finally, they always manipulate the stock market up. And if SPY goes up above the $494, what's going to happen is they're going to take your SPY away, and you're still going to make that $14 that you collected, because that nobody's going to put that take that money away. It's already in your account, and your profit for the trade is going to be $14. I hope I explained it correctly. So if you want to look at it very easily, your cost basis is now reduced to 480. You are willing to sell SPY at 494. So if it's above 494, you still keep the $14 that you spent. But I know all of you are greedy bastards like me, and says, Tony, what happens if it rebounds like crazy? So your maximum profit for your trade here will be 494 plus 14 equals $508. So if the SPY goes above $508, well, guys, you're out of luck. The reason why you're out of luck is because you sacrificed some upside. You sacrificed some upside, by selling that call. Your cost basis now, got reduced by $21, but there's no free lunch in this world. If you want downside protection, you have to give up something, and what you gave up is the upside for SPY, right? So now, what happens if the stock goes up? Your call gets in the money, and after expiration, something magical happens. Something incredible happens. So you have 100 shares of stock and you have an in the money call. You're gonna something called getting assigned is gonna happen. And they're gonna sign the short call, and they're gonna say, Tony, now you're short 100 shares of SPY. But on the other hand, your other left hand, I have two left hands. In your other left hand, you have 100 shares of SPY, and on this hand, you have short 100 shares of SPY. And what happens? Algebra again, boom, and the wheel is completed. You're left with nothing. Well, not necessarily nothing. You're left with some money, baby. You're left with those beautiful $14 that were deposited in your account. And that is the wheel in summary. I'm going to talk, before we close the video, I'm going to talk what happens if we keep going down, right? If we keep going down, you have to rinse and repeat. So let's just finish the scenario of SPY going above our call strike price. So if SPY goes up above our 494 strike price, and we get assigned, we're gonna be short 100 shares of SPY, but since we're long 100 shares of SPY, they're gonna take it away. And in this wheel system, we got two assignments. The first assignment, we got assigned on our short put because the SPY went below $501, and we got assigned. And when you get assigned on a put, you get 100 shares of stock. So our 100 shares of stock that we originally got, we didn't buy. We didn't buy stock. We got assigned 100 shares of stock. So our short naked put converted, created. It's like a beautiful butterfly. When a worm converts into a butterfly, our naked put converted into 100 shares of SPY. When we sold that call and the call got assigned, that call also converted to a very scary short 100 shares of SPY. But don't be scared, because you had 100 shares of SPY here from your butterfly, your worm that became a butterfly, and boom. And when you are when the wheel is completed and you're left with nothing because the call took away your shares, what do we do, boys and girls? Well, it's quite easy. If the market took away your SPY shares, don't be sad. Do you think Uncle Tony's going to be sad because he made $14? Never, never. I would be happy. And what do I do then again? Well, we go in the wheel. We start again. We sell our naked put again, and we start our wheel strategy once again. But Tony, what happens if I sell the put and the market goes up? Well, you're blessed. You make money, baby. You will not get assigned your 100 shares of stock, and you will keep that $7.21 in your pocket and be happy. Never be angry, never be sad when you make money. So if you sell the put, market goes up, bingo. You sell the put, the market goes down, you get assigned 100 shares of stock. You find your break even. You sell the call at your break even. And if the market goes up, the calls are going to go against your 100 shares of SPY, and boom, that's it. Back to normal. But I know my doom and gloom followers. Tony, tell us what happens if the stock market keeps going down, if we're in a nasty bear market. So that's fine. Let's go take a look at our Tasty Trade platform and see what we can do now. When people say you have to be very good at math to be a good trader, I would say not really. For the wheel strategy, you do need to know something. You need to know your cost basis. And how do you know your cost basis? Well, it's not very hard. You just have to understand how to add and subtract. If we go to our trading platform and we said that the SPY kept going down, we know our new cost basis for our trade is around $480. Let me get myself out of the screen. And if it's $480, let's pretend time passed. So I'm going to go now to the April expiration to pretend time passed. What is the at the money call? Because, even though it says 500, but let's pretend now that SPY is at $480. So if it's at $480, and let's pretend we get $12.50 for a call. I rounded out the numbers to make it easier for me on the math, even though it says 1280. So once again, we go to our break even. We find our break even on the trading platform, and we go to the next expiration and we sell the at the money call. And what happens when we do that? Well, something magical happens, boys and girls. We keep every time you sell something, you put money in your pocket. Every time you put money in your pocket, you're doing something very fancy called cost basis reduction. So now let's take a look at our new cost basis reduction trade. So here we are. Remember, we sold a put for $7. We lowered our cost basis. We sold a call at our cost basis of $4.94. We got another $14. And now, now we're again, since our cost basis is 480, we're going to sell the 480 call. And in my example, I pretended that we got $12.50 for that at the money call at 480. And our cost basis is now reduced quite significantly. How much? Well, let me tell you how much. So we had our cost basis of $4.79. We got another $12.50, and our new cost basis is this one, $467, and we have collected a beautiful, a gorgeous, a unbelievable $33.87. Where did these $33 come from? It came from $7 from the put, $14 from the first call, and $12.50 from the second call that we sold. And once again, SPY kept crashing down on us, and we kept lowering and lowering and lowering our cost basis from 501 to 493 to 480 to 467. And that's how smart traders trade. That's how smart people trade. And once again, what happens if it goes above 480? They're going to take away your shares. They're going to take away your call, and you're going to keep that money in your pocket, and you're going to be super duper happy. So you see, trading requires math, yes. Not very hard math, no. I'm going to leave this information up here a little bit while we talk a little bit. So I wanted to share this comparison. When should you use the wheel strategy against buying long stock? In my case, I would always use the wheel strategy. But some people are greedy. They think the stocks can go up to the moon. But if you want to buy a stock, but you're not 100% sure if it's the right entry or the right price point, well, don't be scared. Sell the naked put against it. You lower your cost basis. If the stock goes down and you get assigned, don't worry. You sell a call at your new cost basis. If the stock keeps crashing down, what happens? Don't worry. You sell you go to the further down expiration. You sell another call at your cost basis. The only thing that you have to keep track on this game is your cost basis. You see, we started at $501 cost basis. Then we sold a put. We reduced our cost basis to $493. Then we sold at our cost basis a call for $14. We reduced it to $479. Then we sold another call at our cost basis for $12.50. And we collected a total of $33 and reduced our cost basis from $501 to $467.29. And there is another scenario where you don't want to get assigned because maybe it's too much capital, or you don't want to take stock. So what you can do, if you sell the naked put at the money and it goes down, you can keep rolling it and rolling it and rolling it. Unfortunately, when you roll it, you're rolling an in the money put. And what I would suggest is to keep your cost basis in mind and try to roll the put to that new cost basis. What does it mean? In our example, I would roll a put and then sell the 494 put again. And if we went down, then I would sell the 480 put and keep track of your profits and losses. And when you're break even, you can get out. Please look at my rolling short put to understand this concept. If you think the stock is going to the moon, do not do the wheel strategy. Just buy long stock and be done with it. You see, if you want to succeed in trading, you have to learn cost basis reduction. It's a fancy word, but it's not really very hard. Trading is not hard. Trading has a little bit of math involved. Trading is logical. And you see, you learned something very, very valuable today. How to not get killed by the stock market if it starts going down. And you want to feel like, I felt like an idiot. I bought some shares, it went down, and I said, shit, it went down. I feel very bad. I feel like I'm a dumb guy, and I'm not being smart with my money. So if you want to reduce your cost basis, follow the wheel strategy. If you want to grow your pile of money, follow Uncle Tony. And remember, it's crazy out there. But you gotta risk it to get the biscuit, baby.